All right. So I started the recording. Well, my name is Rose, and just a quick introduction on myself. I've been trading for about 5 years since the pandemic. Like a lot of us in this journey, I was new to everything and started by losing money because I basically didn't know what I was doing and just decided to go all in into options. But then over time, I started applying myself, and I've mainly a lot of times been trading um, a lot of kind of small account friendly tickers. But lately, as of around December, I started trading SPX. I traded SPX about 3 years ago, and I had no clue what I was doing, and I ended up losing money. I was pretty, after that, I vowed myself to never trade it again. I was scared. But then the years went by, and as I kind of learned how to be more disciplined and learn more about the market, I'm able now to trade it again. And overall, I have been having success trading it and navigating everything that kind of helps me become a better trader. I'm going to go ahead and head on with the presentation. So a lot of people see a lot of traders on social media post all these crazy SPX gains. You think about, how can I get like that? Or, you know, is SPX what's going to kind of make me rich or whatever? Um, and overall, SPX is very tricky. It can give you a lot of money or a lot of gains quickly, but it can also take them away. It's basically the overall market, and it's the most traded ticker in the market right now. And because you can trade them what's called zero DTE, meaning that they expire the same day, the volatility or the swing in the price of the contract can move exponentially, either to your favor or against you. And so you have to, if you're going to be trading SPX with just like alert signals or something like that, somebody else telling you to get in, it can be very tricky, or you might not be able to find consistency because you kind of need to know what you're doing. So a lot of the things I do, I have my morning routine. And here I'll show you how to choose contracts, understand how VIX affects contracts, what indicators I use, what Confluence is, and when not to trade XPX. So one of the key things about trading overall, and I hope this helps you, even if you don't trade SPX, if you trade anything else, whether it's options, futures, or even just comments. But overall, a lot of people think that in order to be successful, all you need is to know like some form of technical analysis, whether it's ICT, the strat, market structure, RSI, whatever. But people forget there's 3 key elements into becoming a successful trader. And one of them, of course, is having that trading that trading analysis or technical analysis, which is your edge when it comes to the charts or the fundamentals. But people forget that you need to have strong trading psychology and risk management. So basically, with trading psychology, your psychological state is the most important thing in your trading system. Emotions like fear, greed, and self-doubt sabotage your performance, and unless you manage it properly. And so the goal is to develop a calm, focused, disciplined mind that can execute consistently regardless of the short-term outcomes. So this is kind of like what I do, and this is all based on this gentleman called Randy Howe, and I'll post all these links after this meeting. But he's a trading psychologist and has this whole website with free articles and YouTube videos. And I've actually went ahead and took his. He actually has a course, like an individual course, and I took that one's paid, of course, but everything else, like I've done a lot of his free stuff. And he really taught me how to kind of trade, with my state of mind so that I can become a better trader. So with him, I learned how to have emotional regulation, like training your brain to not hijack you, reactivity to, training my brain so that I can recognize when I'm starting to become impulsive, over trading or wrench trading, finding the roots of that fear and or that impulse, basically fear of loss, fear of missing out, fear of being wrong. Those are deeply tied to our survival instincts. And unfortunately, they don't go well in trading. And so you have to recognize the pattern, recondition them instead of trying to suppress them. So basically, with him, we will basically, by managing this, I know, like, why am I fearing a loss? Is it because I'm tying my worth to money? Why? Because I had maybe some past financial traumas, or just overall how your family, is. And then within that, I do like mindfulness and breathing work. So basically, having that mindfulness where I do meditation in the morning, even throughout my trading, and breathing so that I could kind of regulate my nervous system. So you shift from that fight or flight, where instead you're calm. And if you notice yourself before you get into a trade, if you may be not noticing now, but if you start to think about it, you'll notice you might tense up, or you might like start getting sweaty, your heart starts beating faster. So basically that's what I've been regulating, and then building the trader's mind to try to retrain myself to identify those emotional, those impulses, the inner voices, or like emotional personalities that, instead of, it's kind of like you're driving a car, and instead of having the inner critic or the person in you that's judging you, you have the courage, like a warrior, the sage, kind of like you have better emotional personalities. And then having discipline over certainty. Basically, in trading, you need to let go of the need to be right. You need to stop thinking like, well, because this is what I charted, it has to be right. Instead, you focus on the process. I try not to predict the market and say, I think, tomorrow we're going to go to all-time highs. Instead, you more think in a process or a probability mindset, where you think, if I kind of do like an if then. So if we get above this area, there's a higher probability we keep going up, or vice versa. So basically, learning to interpreting my emotions instead of reacting blindly to it. So basically, I just wanted to kind of briefly talk about trading psychology, because for me, that was the big change. I felt like there was a few years where I felt like I had learned, whether it was a strat or market structure, and I kind of had a system of, okay, this is my edge, but I could just not execute. And it was mainly because I was missing that trading psychology part. And then going on, every day I prep for the market, even on weekends. But overall, what I do in the morning, I kind of meditate and pray. As I'm drinking my coffee, I look to see what news there is. Like, I'll go to websites like Forex Factory, and I'll see, tomorrow you're like, there's really nothing going on. So maybe we might not have a lot of movement in the market, or volatility injected in the market. I'll go to Earnings Whisper, and I'll look to see what's on the calendar for earnings. And I'm like, there's really not much going on, other than probably people are going to be looking at GameStop. And then there's this other website called Market Chameleon that a lot of people haven't probably heard of. And I like the reason I like this website is because it has company events. So the free version of it lets you look at the next day, basically that week's events. And so then it'll tell me like, oh, NVIDIA has an event tomorrow at, you know, that may impact the market if, you know, they say something revolutionary. Or basically I keep an eye, it'll make me keep an eye on tech. And so, you know, QQQ or even SPX. And so I look and see, because usually when earnings are low, usually the events are the ones that kind of can move a ticker. And this is a great website if you don't want to trade. Let's say I think, oh, tomorrow's going to be choppy for SPX. Let me look at maybe something else I can trade. Oh, NVIDIA might be it, you know, because it's going to have that volatility injected. So I like to look at this as well. And then I look at the market. So basically I'll look at ES and I'll kind of look to see what happened overnight. You know, I'll look at the 4 hour, the hourly, and just see what are we setting up. Did we, you know, have new brought informations, fair value gaps? Like for example, this was Friday, and so I would have marked this fair value gap here. And that way you see how we react towards, you know, during the day. Because I'm like, oh, if it starts rejecting, maybe it means that we might push up or something. I look at NQ to see if it formed any divergence, meaning did NQ, like for example, overnight, I noticed that ES took over previous week high, but NQ didn't. So there's some divergence there. And it could be that maybe NQ is lagging. So basically I keep an eye on that. I look at VIX, just to see where we're at. For example, on VIX, I marked this fair value gap. Cheryl, can you mute yourself? Thanks. And so I marked that fair, you know, basically look how it's moving. Did it form any gaps overnight? Because I like to mark, like, for example, today, you know, this gap on VIX was filled. And so I like to mark those gaps and see how it might react. And I'll keep talking about VIX later. So basically that's kind of like what I look at overnight. Look for any fibs or like Fibonacci that could have been formed. And I'll go a little bit over my charts in a minute. And then I look at all of some, like I said earlier, as I'm drinking my coffee, I'll just look for any news that may have came overnight that might impact the market, especially right now with all the geopolitical issues. And also there's this website called Roll Call, and every day it prints Trump's schedule. And so I look to see if there's anything that may, like, you know, if it says something like he's gonna, like the other day when he started talking about Musk, it was actually on Thursday, right when he had this conference with even though this says the president greets the chancellor of the Federal Republic of Germany, he ended up talking about Musk during that time, and that's when that whole drama started. So I take a look to see, because I'm like, this guy might say something about either tariffs or, you know, whatever to impact the market. So I take a note just to see, especially if the market's consolidating right before he starts to maybe potentially talk. During market hours, I check basically. Oh, another thing I forgot to mention is that I also have like a morning trading psychological plan, and I review it every morning. Let me see. So basically I have a plan I wrote out, and it tells me my rules. and I remind myself, basically, make sure that I don't overtrade or undertrade, or check, I check my emotions. I evaluate my trades. I evaluate my state of mind. Um, I remind myself, make sure you check your overnight futures, like your fundamentals. I like having it written down, because it reminds me of, like, hey, remember, when I get to my desk, I kind of like stop for a second. I look, I ask myself these questions. What's my present state of mind? What's bothering me? Like, is it maybe something personal in my life or work? Am I anxious? Am I too worried? Am I too excited? Um, what what's going on? And then I ask, what assessments are going on. Like, if I tell myself today I don't feel good, I feel like I'm not worth it, then I go back and check, are you sure? And that kind of helps me. Um, I recall, like, my readings of the day, of my prayers, like, kind of like that. I do that right before the market opens. And then I remind myself, don't rush, have patience, because that's what I struggle the most with. Um, I remind myself to breathe. And then, so basically I have this trading plan of my in between, my before and after. And then I I have, so during market hours, I have different watch lists or workspaces in my trading view, which is what I use, basically layouts. I have one for ES and NQ, where I kind of look at them side to side. This is my layout where I mainly, I trade a lot of the strat and kind of some ICT concepts and more like market structures. So that's where I have all those indicators, where I draw my FEGs, my broadening formations, and then where I have my indicators of if we've reached the previous month high, or all those time frame important, previous day low, previous day high, the 50%. There's an indicator I use. Let's see. Oh, it's this one. And I'll send a list of all my indicators as well. But I like this one because I can customize it, and then I can have like the previous time frame, 50% high and low. And that way I can add all of them and change them to whatever color I want, so that I can have it on my chart, because those time frames are really important. For example, I'll show you today. Today, the low of the day was actually the yearly open. So this has been, and if you notice, we've kind of been gravitating around that yearly open. And because it's a bigger time frame, it's more important, or it kind of has a little bit more of a magnet to it. So today I noticed, like, we went below it, but then we were able to kind of again stay above it. When, like I said earlier, we took out the previous week high, but if you look at the hourly, we kind of never were able to close above it. So that's kind of telling me, hey, we swept that, and now we might try to come down. Do we come down to like 50% of the previous week, which would be a big move down, or are we just going to chop around? So kind of like I start to establish those scenarios of what could happen. Do I tell myself, I've noticed that this broadening formation I drew from here to here has just been getting, like, we can't close above it. So that's telling me another story. The market wants to come, maybe retrace a little before the next leg up. I look at where we are on the month, where we are on the week, and ever since we shifted the weekly, the weekly's headed to the upside, the daily as well. We have market structure to the upside, the 4-hour and the hourly. So that tells me, instead of looking for short setups, the setups that may may work better are looking for longs, and that's when I start drawing what I said earlier, the Fibonacci, which is what's called the optimal trade entry, where I can do it as tight as this one, where it's from the previous swing low to the next swing high. And as you can see, we have the 0.75, the 0.618, and 0.5. And as you can see here, we perfectly kind of wicked off it. So that's telling me, hey, if the market wants to keep going up in this little tight area, it wouldn't even lose this, this 0.75. It would just, keep going up. And this could have been an entry. The higher the time frame, the more it tends to be respected. So, on the daily, we kind of would have to do it from this swing low to basically the highs now. And that's kind of like here where we retraced, and the lowest we've had lately has been that 0.618. So that's telling me, let me look for long setups, even though the market, is probably gonna come down eventually. If you're just day trading, you're not swing trading it, then you can look at those smaller time frames. Also, I like to see what range we establish overnight and kind of make sure that we don't, do we break it or do we not? And that's where there was the day before the drama happened with, here, we had established a range around like here. We were kind of like ping-ponging around this area. And if you notice, we didn't really it was actually like around here. Yeah, because we never closed. We ping-pong around this area for like Tuesday and Wednesday. So now I wait and see. I won't, I'll tell myself I won't take any trades. Or if I do, I'll only do them at the lows and the highs before, because we're just going to be ranging. And if you're trading SPX, you're just going to get theta burn. And so here, we didn't have good movements till we started breaking the range. So now I look at tonight and I'm like, this is kind of like the range we're establishing now. And it's also a tighter range. So let me see what happens here. So I started to look at that too, because if you notice, especially lately, we've been moving in smaller ranges, and either the big movements happen overnight or they just kind of happen quick. So that tells you, like, should I really get into a trade if you're in the middle of this range? Most likely not. So yeah, that's basically what I do during the day. And then another tip that has helped a lot of people is before I get into a trade, I have what I call my Confluence list. And it's basically a list of all, let's see if I can find it. Hold on, I have it somewhere here. Triggers. Yeah, basically what triggers in the market do I like? Let me make this bigger. And so I'll have a set of things that I like to look at on SPX before I get in. And as I'm starting to see a play develop, let's say that I tell myself, hey, the higher time frames are more on an upswing. Let me look for calls. So then as those start to develop, I start checking things out. And as, I keep checking them, the more I check, the more that gives me that confidence that, hey, because all these things are lining up for this trade, this means that I most likely, it has a higher probability of it working, instead of just jumping in because you only saw one thing. So that's actually helped me a lot in either not getting in or getting into a trade. Before I get into a trade, I like to set my target. So for example, today, let's say when I saw this, today, for example, I didn't trade today, but I was like looking at the market and I saw that we were kind of rejecting that previous week high. This box right here is a fair value gap for March, and that brought information. I could have easily said, hey, if I'm going to get in a trade, maybe I'll go down to the 5-minute and kind of wait. And I could have either gotten like in here when we rejected this previous week high, and I would have set a small target of, I think, let me exit at the daily open, because most likely that's going to be a place where it's going to find some support. Or you can even look back at your chart and say, I'll exit at this equal lows. And that's kind of like, that would have been a good exit. And so before you enter the trade, make sure you have a plan of exiting. I don't trade SPX based on the percentage, meaning like I won't say, if once I hit 50%, because sometimes like the move might happen quick where you get your 100% or something real quick, or it might be slow. And if I'm still in profit or around break even, I don't get out. If I do see that, let's say I got into a put and it just started not going my way, like let's say I would have gone into a put here, and then I start seeing this build up, especially when you have this like 113, like all these ones, and I tell myself, hey, I think this is done going down, let me just get out. Then I get out, and it could be 20% loss, 50% loss, sometimes 70% loss. But because I only buy 1 or 2 contracts, I'm okay with that loss because my wins are usually bigger. So I can have like 5 losses in a row, but 2 wins will make me even more profit than those losses. So that's kind of like my risk management. During the day, if I take 2 losses, I just sit out. If I take 2 wins, I sit out, because then you can start over trading, especially when you're choppy. So that's kind of like what I do when it comes to that. And let's see, what was the other one? So yeah, definitely that list also, like I said, has helped me a lot of times. And you can create your own with whatever you use or whatever you like. And you'll see how it starts to help, because if you, like I said, if I only see like, hey, there's only like, my favorite strat combo, which is the 1-3, and I only see it on one time frame, there's really no point of, trade. It'll be lower probability. So that helps a lot. Let's see what else. And then after hours, I posted it in the chat the other day on the weekend. I think I like to journal every trade, look back at the chart and see what I missed, especially because when you're not trading, when you don't have money on the line, you kind of start to see things that you missed. Or I like to see where the best entry and the best exit would have been. What did I trade? Like, did I trade out of emotions, or was it really part of my plan? And then I look to see how are we looking overall. Like, for example, did we have, did the market end on an inside day, or are we a doji? Does it look like, kind of look at all the time frames and start to develop a plan. But then I like I said, I like to wait for that overnight data to come in before I actually have a clear plan. I'll be talking about TRIN in a bit, and then basically just kind of prep my mind for the next day. And then One of the things I use a lot that others don't, or maybe that might be new to people, is I like to use ES futures to trade SPX. The differences between each, if you don't know, is futures trade 24 hours or 23 hours a day, 5 days a week, whereas SPX is only during trading hours, which is 9:30 to 4. The liquidity is extremely high in ES compared to SPX. There's some tax differences, and then I just, the charting continuity, it just includes overnight data, whereas SPX doesn't really. And basically the way I do it is I track the overnight price action since it trades nearly 24 hours. So I look at the overnight sentiment that we create any, for example, when ES opened today, I look at the 5-minute and I'll see that we created any gaps. And if so, I mark those. And today we didn't, so we should be fine. But usually when there's any, it's the ICT concept called new day opening gap. You mark that because the market might come down to it. I look at what ICT calls kill zones, and I look to see, what did Asia move? Did London move a lot overnight? Because if the market moves a lot overnight, then most likely during the day we might chop more because the market already made its move. Let's see. And then I mark like I said earlier, I'll mark any fair value gaps or blocks, anything I see. ES often leads SPX slightly due to higher liquidity and continuous flow. If you're trading SPX options, like I said, I anchor key levels to ES, and then I watch to see how SPX reacts to this zone. One indicator that I'll add on my when I'm done as well is, let me go back. There's this one called ES SPY SPX ES price, and I like it because it has this little box up here that tells me the price of SPY SPX and ES. But if you want to like kind of see like what the equivalent, like for example, the equivalent of SPY 600 is kind of like where ES is at right now. Or SPY 599 is 604. So that kind of gives you an idea if you're using it to trade SPY or SPX. That gives you an idea of, hey, if I have my alert for ES at this level, that means that that's my target for SPX or SPY. Yeah, because so it's the same with SPX in it. So that's why I like that that indicator. And then I actually use, and I'll show you about Saty's indicators in a bit. That's going to be a good one. But I use, like I said, the strat kind of to anticipate moves within SPX. So basically, if I see that ES breaks a key level and SPX is lagging, then, like for example, if ES goes 2 up on the day and SPX is still lagging, then that means that we might get a little push higher. I know I also use the average daily range, or ADR. And so if, for example, if ES already went, took out ADR, which I don't know why it's not, which here it's actually really high right now. For ES, it's upper ADR is around 60.44 and lower is 59.79. If I see that ES already took it and SPX hasn't, then I'll be cautious on getting into calls, and vice versa. Let's see. And then with SPX, the other thing I look into is gamma, which could be, when you're looking at it at gamma, it could be support and resistance areas. So for example, earlier in the day, the gamma for the 60-20 kept growing. And so that tells me like, hey, SPX might want to go up here. That means they're positioning themselves there. So I'll look at that as well to kind of gauge and see what may be like a good trade idea. Let's see. And then yeah, I mean that's pretty much what I do for that. When I start looking at SPX contracts, I have a scanner that kind of scans by volume. What are the contracts that are the most kind of have the most volume? And I like to see, especially towards the end of the day, because for example, today when SPX was around 60-20, the 60-20, 60-15, and 60-10 call were kind of like at the top and we're in the money. So that tells me that there's a point where the market makers might try to kill those premiums. So then I started looking to see if I could scalp a put, and you could have scalped the 610 put. When I looked, this put was at 80 cents and it ended up closing at $4.40. And I'll talk about that later. But when it comes to choosing the contract, you have to know based on how the VIX is moving. So for example, right now, the VIX is under like $20. So it becomes a little bit, the lower the volatility, the lower the IV in the contracts is going to be. So the good part about that is that you can probably get a little bit closer to the money cheaper, but you just can't, you have to make sure you don't get too out of the money where, for example, if the average move for SPX right now is 50 points, you don't want to get 100 points out of the money, because the probabilities of that coming into fruition are less. And as even if SPX may be going in your direction because it's going slow, it might not work. I like to trade SPX wait. Unless I'm going to scalp the first 30 minutes, I like to wait for after the first 30 minutes so that let the volatility die a little and let those premiums die a little. And then I like to exit. I don't like to stay more than like 2 hours, for example, because then any move against you just starts killing those premiums. And then towards the end of the day, I like to wait for the last 30 minutes. You can get some really nice scalps, and I'll show you how later. But basically, because right now, so for example, when VIX was above $30, when we were all the way up here, the contracts were expensive, but we were getting bigger moves. So you could easily get a 500 or 1,000% trade if you timed it right. Whereas now you really have to be a little bit more precise, but you have that, you can kind of get it for cheaper. So basically with the way VIX is going, either if it starts to drop more, like if it goes below 15, then I might just start either swinging SPY or swinging like other things, other tickers, because it just gets too, it doesn't have much movement, and you're just gonna have, if you're playing 0 DTE, it's just gonna get eaten up. And so that's kind of like how I look at it that way when I'm trading it with the VIX. Let's see. But yeah, when it comes to choosing contracts, like I said, it really depends on the time and just knowing what range. So if the average daily range right now of, let's see, of SPX right now, it's 68 points. So at open, you know, you don't want to get something where $100 out or 100, you know, points out, because you already know that it could happen, but it's just the probability is not, it's rare. So you look maybe 20 points out, and then that's where you have to be precise on having all those confluences line up so that they line up to your to what side you think the market is going. And then so another thing I wanted to show you that I've found out about recently, and this is about market internals, which I found out through John F. Carter's Mastering the Trade, this book. And I actually can even post a copy of the online version of the book. But there's these market internals that kind of tell you, it's kind of like, you know, let's say you're looking at a car and you see it driving, but the market internals will, it's kind of like looking under the hood, like, are we about to need an oil change? You know, where this thing's gonna stop, what's going on? So one of the first ones is called tick, and that measures the cumulative buying and selling pressure for the NYSE and other equity markets. And any tick reading between negative 400 and 400 is just noise. It should be ignored. When you start seeing ticks above 600 or under 600, there's starting to be some conviction in the air. And I'll show you in the charts in a bit. So the larger the number, so if we keep getting sustained readings about 800, and so you know, let's say we keep getting readings that are plus 800, and you're in a short, you probably are on the wrong side of the market. Look at the spikes. So if they keep staying high, or like plus 1,000 or negative 1,000, you know, that means the market has a high conviction to that area. So meaning if it's plus 1,000, mainly it has a high conviction long. Negative 1,000 means a high conviction short. If you see it like spike up and then drop back, then that usually means it was like one of those fake outs that the market tries to do. So I have this other layout where I look at tick, and so basically it just moves in these spikes. So right now you look at this and it looks meaningless, but I look at it on the 5-minute. Usually the first 30 minutes don't really matter. It's more throughout the day. You can have it marked. You know, today we really didn't get many spikes above 600, and so that was or below 600. So that's telling me that, hey, we're probably in for a choppy day. Shouldn't really, especially, you know, shouldn't really like either look at the market or care. Just know that it's going to be a volatile day or a non-volatile day. And this is one of the key things I like to use, that, you know, you ever wonder like, hey, when will I know if we're actually going to move or not? Once we start, let's see, on days where we kind of start seeing more movements outside and more wicks outside of it to the like 1,000 area, then you're like, okay, we're about to be moving a lot. So this is what I use this for, kind of like that little heartbeat of the market, to see where market makers are placing themselves. And like you could see today, we really didn't move much. And so that was telling me that we were going to be probably chopping all day, because if you look, even the 400 area, it was just noise. We didn't really have those big moves. And then if you have these spikes like right here where it spiked all the way almost to 1,000, but then if you see that the next spikes don't really sustain above it, then that means that was a fake out move. And that was at 1250. And that's kind of like this candle right here where we had this. And so a lot of people, they'll see this candle and they'll get into calls and they're like, oh, we're about to move. We just had a big red candle on the 5-minute. And then nothing really happened. And the tick was telling you, hey, this was a fake move. And as you can see, the market kind of didn't do much after that. So I like using that. Then you have ADD, which is number of advancing stocks less than the number of declining stocks. So when the line is sitting at extremes for its range, which is either above 1,800 or 2,000, or below 1,800 or 2,000, we are looking at what's most likely going to be a trend day. If the ADD is strongly in one direction, that could also be a trend day. If it starts making, if like SPX starts making new highs and ADD isn't, it could mean that, you know, it's just propped up by heavily weighted stocks, but that the market, overall market, is not, you know, in that trade. And so one of the things I've used, so I have ADD here, and so there's times I've used it. There was this day, let me see. I'm trying to see. There was one day where I think it was here. Yeah, it was here. Kind of SPX was moving up the first like 5 minutes, but the ADD wasn't. And I did like a quick short scalp that day because I realized that it was kind of diverging itself, and that kind of helped me scalp it. I think there was another day I did. Oh yeah, here was another one. Actually marked the lines. The first two right here were going up, and sorry, these two were going up, and then ADD just kept going down. So I actually got into a put here, and I ended up getting like 300% or something, just because that gave me that additional confluence that this wanted, you know, this move wasn't good. So that's what I use it for. And I'll paste some YouTube videos too on these two guys that talk about the strategy. The TRIN is and by the way, I know it's been an hour and I might be going. Is it fine if I keep going? Just wanted to check with people, and if you have to leave, it'll be recorded. So the TRIN, this one, I only look at it at the end of the day, and it's known as the ARMS index, and it tracks the number of advancing stocks and divides by the number of declining stocks. You can use it intraday, but I just like to look at it at the end of the day. So if more volume goes into advancing issues than into declining issues, the ARM index falls below 1, and then vice versa. So then you can look for intraday, you can look for calls or puts. But what I like to look at it for, and I'll show you how this worked. I like to look at the trend of the trend. So if it closes below 0.60, it has an 80% chance of selling off the next day. Whereas if it closes above 2.0, the market has 80% chance of rallying. And that doesn't happen often. So if you go to bar chart, oh, here it is. I think I can. Dang it. You can look at the history. And so I only look at the close, which would be the last. And so I'm looking to see if it closes above 2. And the last time it did that was April 8th. It closed at 9.99, which is like on the higher end. It's way above 2. So what happened? So that was April 8th. What happened April 9th? Boom. April 9th was the day that that Trump announced the pause, and that's the day that we flew like 400 points in a day. And so as you can see, this reading is like extremely rare for it to close, because usually during the day it might go to 9.99, but it's more where it closed, and it closed there. So the next day I honestly would have been looking for a more Confluence to enter a call instead of trying to look for puts. And so that's what happened that day. And I think even if you look back on that day, like for example, on the 30-minute or on the hour, we had these little hammers. The market was kind of telling you, hey, you could take we had a 1-3, which that's my favorite strat signal. You could have gotten into a call and then catch the move. So that the trend tells me if we're preparing ourselves for a big move the next day. And actually the following day, it gave a reading of, where is it? So the following day, it gave a reading of 0.12. So the next day, so on April 10th, instead of looking for long setups, I was looking for short setups. And I ended up catching this move right here. This whole move, I remember. So, and anything in between is just noise. So ever since those 2 days, we haven't had a reading that closes, above either 2.0 or below 0.6. And so since we haven't had a move like that, I don't, we you notice we've been choppy, but then I don't think, okay, tomorrow is the day that they're going to make a huge announcement and the market's going to go ballistic. So basically, it's kind of like these market internals. Someone always knows, and this kind of gives you a signal of, hey, the market's about to be moving. So this is a nifty one I found that I've been able to. I know December 17th, the TRIN also closed below the 0.6, and then we had that 200 point sell-off on, or 20-point sell-off on SPY. And I remember the next day, the December 18th, was when Powell, I think he announced either cuts or it was the rate day. And I remember some puts went like 10,000% if you had 0 DTE. I didn't catch the whole move, but I remember. But now that I learned about this trend, it's been super kind of, now I know I'll anticipate, and it has 80% chance, so it's not 100% effective, but just I'll at least might have an idea of where the market might move that day, which direction it might favor, especially if you start to see chop intraday. And then the PCVA, which is the put call ratio, it just kind of it's a combined index and equity put call ratio. And so if the combined ratio reaches over 1.0 intraday, ignore short setups and start looking for long setups. So basically it represents extreme bearishness and put buying. As a result, it places a floor in the market. And then if the PC ratio falls under 0.60 intraday, then ignore long setups, because the market might be setting itself up, to come down. Other market internals I use is the VIX, which is what I mentioned earlier. Basically, one of the things when I have my view on trading view, I draw, on the VIX, I have Bollinger Bands. And basically, once it starts reaching the top or the bottom of the Bollinger Bands, I'll be careful, or I'll expect like a reversal. And but lately, it's been a little bit harder just because the VIX has been like kind of choppy. But that I keep that in mind. And then you have the other one, or like I said, VIX under 18. It it just gets a little harder to day trade because you get more consolidations during the day, especially VIX under 15. So you expect a lot of chop in those days. And then the vol speed is the difference between the amount of volume trading above or below yesterday's closing price. I kind of just use it the last hour of the trading day. Basically, if you see a lot of buying pressure, meaning it's sustained, then look for a rally towards the end of the day. And then if you see a lot of selling pressure, then into the final hour, then look for a sell-off. So usually once I'll like put it on my trading view, which is all towards the end of the day, and it'll just show me like kind of like if you start to see it come down, then I'll mostly look, if I'm trying to trade the end of day, then I'll look for like short setups instead of trying to look for long setups on SPX. See. And then the next thing I use is, there's this guy on Twitter that has all these free indicators. His name's Saty. So basically, he created all these free indicators, and he has a website. And so I'll go over them. Basically, I have another layout on my trading view with basically his ribbon, his ATR levels of phase oscillator, and then volume stack. So basically, I'll go over them. His pivot ribbon, it kind of tries to give you to find a trend direction or support and resistance. It changes as the trend shifts, and then after like long directional candles, it tends to shift. So basically, above the green ribbon, you can look for longs, and then below you can look for shorts. He has his Saty ATR levels, which identify institutional price magnets. Basically, they're horizontal lines, and so he'll have like a call trigger and a put trigger, and price tends to either react strongly at those levels or gravitates towards them. So I use them either for exits, for targets, or exits. His phase oscillator, it shows like momentum and divergence. So basically, I like to look at a divergence, and basically if price makes higher highs but the oscillator makes lower lows, or vice versa, and then usually those divergences lead to reversals and pullbacks. Then he has his volume stack, which breaks volume into buy and sell volumes and stacks them based on which side has higher volume. So unlike other buy-sell indicators, his displays, his will dynamically stack the higher volume side on top. And for example, like if we have green over red, that means there's more buy side volume. And let me just show you some examples on the chart. And on his website, which also he has like where you can download them for Thinkorswim or TradingView. He has YouTube videos on, kind of gives you more examples and how to use them. Let's see. So then on the chart, I'll show you today's example. So let me edit this real quick. So basically, this blue line is the call trigger, which is at 60.1978. And if you notice, today we actually, that was kind of like the top. And so today I realized we were going to be choppy, but then I also wasn't looking for calls above this because I saw that it kept resisting it. And towards the end of the day, like puts probably could have paid, but not really because overall we were still choppy. But I use it, like I said, as levels of resistance or support. Like look at in the morning, this line right here, this level was support, and you could have taken a long there. And sometimes like if we're truly aggressive, like kind of like on Friday we opened above the call trigger and it just went all the way up almost to the top, which he calls this area, he calls the Golden Gate. And on his, I like looking at the 3-minute intraday and the 10-minute for plays. And then let me show you a good example of the divergence. Let's see. And of course, the higher the time frame, the better it plays out. Okay, here's a good one. Here's a kind of good one where you could have realized that we were kind of done going long. And here, SPX was making higher highs, but then the oscillator here wasn't. And so that was telling me, hey, it's time, maybe time to wrap it up when it comes to longs. And if I want to look for a short, let me show you. I use this if I want to trade the last 10 minutes of the market. I like to use this. Let's see, let me show you. Unfortunately, though, the last 10 minutes have been choppy. I was able to find some plays before. But when we're in a non-trending day, if you look for these divergences, you'll be able to find like some good trade setups. So for example, I think here, where'd it go? On the 10-minute, found one earlier. Oh yeah, so on the 10-minute here, we were making like lower lows, but then the divergence here was kind of like, it was starting to not really make lower lows. It was starting to calm down a little. So that was telling me, hey, might be time to look for longs. And you could have caught a nice long right here towards the end of the day. On trend days, if you're using, the divergences don't really work. So usually what I do is instead I use the ribbon, and this green line here, this middle area is the 21 EMA, and I look for bear flags for continuation. So basically you look for it to retest the ribbon and then get in. And that kind of, so this day that we had like a big rally, it just kind of worked throughout the day. The market never told you, based on this, never told you to get out. So that's how I use it on trend days versus just days where we get different directions. And you also, not every divergence works. You have to look at the higher time frame. So for example, this phase oscillator is kind of based on kind of like Fibonacci. And so here you're at the higher end, basically, you know, when you're reaching 100 versus when you're reaching negative 100. And so if you see divergence on the lower time frames, but let's say that the hourly is still like the pink area is compression, meaning it's consolidating, and maybe the 30-minute is still consolidating as well, then it might not work. Whereas when they all line up, then you're like, okay, this is more likely gonna work out. For example, here's one on the 30-minute where this was making higher highs and this wasn't. And so this could have been a good short. And then you can look into the smaller time frames if you spot something similar for an entry. So basically, yeah. So basically that's how I use this. I use his volume stack as well, because like I said earlier, he basically uses it kind of like what's on top is what's more coming. So if you see it flip, or you know, especially on the lower time frames, then you can try to guess and say like, hey, I think we're about to flip more bearish than bullish. Or if we keep flip flopping, then that just means we're just going to be choppy like we were today. So those are kind of like the three layouts I have on my chart. Like I said, my main thing is ICT, or market structure, price action, and the strat. But I like to use the market internals, and I like to use Saty's indicators to kind of give me that extra confluence where I could check more boxes if I feel like something's about to happen. But yeah, other than that, any questions? I'll open it up. I know it was a lot of info, so if you know, this was recorded, so you can review it as well in the future, and like feel free to also DM me if you have any, or message me if you have any questions. But yeah, that's all I have. If there's no questions, I'll be on Discord if anyone else has any questions afterwards, and then once the video is ready, I'll also post it there.
Rose, thank you so much for hosting the class tonight.
Thank you.
That was great.
All right.
All right,
Thanks,
girl.
guys.
Take care.
Take care. All right.